What are the margin requirements for trading on the CBOE? Are you curious about the margin requirements for trading on the Chicago Board Options Exchange? Understanding these rules is essential for anyone looking to trade options effectively. Let's break down what you need to know. Margin requirements are the minimum amounts of funds or collateral that a trader must deposit to open and maintain options positions. These rules are designed to ensure that traders can cover potential losses and help reduce credit risk for brokers and clearinghouses. First, let's talk about the two main types of margin: initial margin and maintenance margin. The initial margin is the amount you need to open a position. You typically need to pay this amount promptly, usually within 1 day. The maintenance margin is the minimum equity you must keep in your account after opening a position. Sometimes, you may have up to 15 days to meet this requirement. Now, the margin requirements can vary depending on the type of options position you are trading. For long calls or puts with less than 9 months until expiration, you need to set aside 100% of the option premium as margin, and there is no maintenance margin. If your long calls or puts have more than 9 months to expiration, you will need to set aside 75% of the option premium for both initial and maintenance margin. For short calls on broad-based indexes, the requirements are a bit different. You will need 100% of the option value plus 15% of the difference between the index value and the out-of-the-money amount. Alternatively, you can set aside 10% of the index value, whichever is greater. The maintenance margin for short calls equals the initial margin. Short puts on broad-based indexes have similar requirements. You will need 100% of the option value plus 15% of the difference between the index value and the out-of-the-money amount, or 10% of the put exercise price. Again, the maintenance margin equals the initial margin. When it comes to covered versus uncovered options, writing covered calls can qualify for reduced margin requirements. This is because the risk is lower when you own the underlying security or a related exchange-traded fund. The Chicago Board Options Exchange has also introduced enhanced margin treatments for index options overwriting strategies. This allows traders to write cash-settled index options against long exchange-traded fund positions with potentially lower margin requirements. Another important aspect is portfolio margin and cross-margining. The Chicago Board Options Exchange supports portfolio margining, which calculates margin based on the overall risk of your portfolio rather than individual positions. This approach recognizes offsets between hedged positions to help reduce margin requirements. Cross-margining programs allow for margin offsets across different clearinghouses and product types, such as options and futures, further reducing margin costs for hedged positions. Lastly, it is essential to note that the margin rules at the Chicago Board Options Exchange comply with Regulation T of the Federal Reserve and other regulatory standards. This ensures that the margin requirements align with broader market rules. In practical terms, if you are trading on the Chicago Board Options Exchange, you must maintain sufficient margin to cover potential losses on your options trades. The specific requirements depend on the type of option, its expiration, and whether your position is covered or uncovered. These rules are in place to protect both you and the market, reducing default risk and encouraging responsible use of leverage in options trading.